welcome to Markets Today. I'm Lata Venkatesh, and joining me from New Delhi is Surabhi Upadhyay. Well, it was a day when the markets didn't quite chime with global cues. Most of the Asian markets and the global cues were positive, but India was beating to a domestic drum, that of the credit policy. It disappointed in the sense the markets were expecting a rate cut. Not only they didn't get one, it appeared that any future rate cut is either unlikely or at best very, very limited to one cut. And that perhaps disappointed the markets, but it was all for just an hour. After that, the markets picked up steam, and although the Bank Nifty underperformed, it looks like at lower levels there are buyers. Hi, Surabhi.
Hi, Lata. Yes, lots to discuss today. All the analysis of the policy, the fine print, and reactions from equity and bond market participants. All that coming up over the next half an hour. Let's start with the headlines. Rajan Goads bankers to pass on previous rate cuts to consumers, keeps repo rate and CRR unchanged, says future action to also depend on food price movement and on supply side responses by the government.
Even as RBI urges banks to cut rates, bankers say they will wait for deposit costs to fall further. Most see base rates falling between now and June.
RBI moves to liberalize the bond markets will allow Indian companies to sell rupee-denominated bonds in the overseas markets under the external commercial borrowing banner, announces steps to encourage retail participation in the domestic market for government securities as well.
A volatile ride on Dalal Street as the market digests the Reserve Bank policy. Nifty gyrates in a 100-point band and then finally ends in the green, but marginally changed. Rate-sensitive sectors like banking and realty see pressure, while metal and power stocks see gains.
Well, before we delve deeper into all the developments, here's what we've lined up for you on the show today. Nilesh Shah of Kotak Mahindra Asset Management and Nirmal Jain of IIFL weigh in on what they expect from the markets as earnings season unfolds and policy is behind us. But Lata, let's get down to your analysis and the key takeaways from all that we heard from the Reserve Bank today.
Well, that's right. The key takeaway from the Reserve Bank was that they expect inflation to be at 5.8% by March 2016. And for the longest time, the Reserve Bank has said that it wants investors, savers, depositors to get 1.5 to 2 percentage points above that 5.8%, above inflation. So if 5.8 plus 1.5 is actually 7.3, the repo rate is at 7.5. There is at best one cut. But the governor often wants that increase to be 5.8 plus 1.75. That is the kind of returns he wants for the saver. Then you're already there at 7.5. There are no more repo cuts. That's the basic message that we got from the Reserve Bank today. From the bankers itself, it was different, but we will come to that in a bit. Let's just hear out the governor.
I don't think we're looking for a specific number and saying unless this happens, nothing more will happen. But we want to facilitate the process of transmission. I don't see an environment where credit growth is tepid. Banks are sitting on money, so to speak, and their cost of funding, their marginal cost of funding has fallen. The notion that it hasn't fallen is nonsense. It has fallen. They can borrow at the margin today at 7.5%. We've kept it. There's plenty of liquidity in the markets. So at some point, the pressure on the banks, the competitive pressures will tell. We're going to look at the base rate. And we're going to try and push banks towards marginal costing of the base rate rather than average costing so that they can move more quickly. And marginal costing seems the right thing. If you are able to raise deposits going forward at a lower rate, that should feed into your base rate more quickly. We're also going to have financial benchmarks on money market rates, for example, so that banks can use that to determine their lending rates. Instead of having a base rate, use the money market rate, short-term, medium-term money market rate.
At 5.8 plus 1.75, by your own arithmetic, there isn't any scope for cuts.
Well, if I wanted to be hawkish, I'd say 5.8 plus 2. If I wanted to be dovish, I'd say 5.8 plus 1.5. So there is room if we want to look for it. We just need all the other pieces to fit into it. As far as Fed policy goes, we are not, in some sense, saying that will be a determinant. We are more focused on the domestic economy and the domestic requirements. Of course, Fed monetary policy has an effect around the world, but at this point, as we say in the statement, we feel we are adequately buffered. And so that is not going to be a key factor or the key factor in determining our monetary policy stance going forward.
Right. The key takeaway was the RBI pressure on banks, but banks still remain reluctant to cut rates. While most bankers agree that rates will come down eventually, they are not ready to move just yet. SBI's Arundhati Bhattacharya said changing to marginal cost of funds will take a long transition period. Aditya Puri of HDFC Bank hinted that banks will cut base rates in the first quarter of this fiscal that has just started.
Deposit rates, we are fixed on the liability side, in the sense that when we take a deposit, we take it at a particular cost. And therefore, to reprice the entire asset base on the basis of marginal costing itself, it would be something that if we even think about doing about it, it will have to have a very long transitioning period. It can't happen tomorrow. We see it as an easing cycle. Internally, we are finding that we believe that the inflation will come down, and our inflation prognosis is lesser than what the central bank has given today. So given that, given the easing cycle, rates are definitely going to come down.
It's not just the repo rate cut that determines, or the repo rate change that determines the base rate change. It depends on the cost of funds, it depends on your deposit mix, it depends on the liquidity situation, and it depends on the credit offtake. And I think that approach or answer remains constant, whichever way the repo rates are announced. Of course, what do you see the trend on base rates? I think clearly, as you saw, some amounts of deposit rate cuts started since November. It is, the whole cycle is easing, and you would see rates coming down.
Lag is a function of cost of funds. डिपॉजिट रेट नवंबर से घट रहे हैं, अब थोड़ा और घटेंगे. जब वो घट जाएंगे तो कॉस्ट ऑफ फंड्स नीचे हो जाएगी. कॉस्ट ऑफ फंड्स नीचे हो जाएगी विद इन 1 quarter as per RBI regulations of the there you have to cut your base rate. So somewhere between now and June, if the banking system, which has not at the moment largely reduced interest rates, अगर वो interest rate घटाता है तो अब और जून के बीच में जरूर कुछ घट आएगा. अब आप पूछेंगे कितना, जितना कॉस्ट घटेगा.
All right, no clear, immediate promises of a rate cut there. Lata, where does this leave the consumer really? I mean, as you mentioned earlier, it seems the Reserve Bank itself may not be as generous with future rate cuts in this calendar year. Then we have bankers which have been saying that yes, we're in a downward easing environment, but they aren't cutting rates. Where does that leave the consumer?
Well, not much to gain from rate cuts. Clearly, if you're a market trader, the rate trade is over. Buying banks because bond prices will rise, because yields will fall, that trade is over and done with. For the consumer, the banks clearly have a scope to cut rates once. They have not passed on so far. This is the slack season starting from April 1. In the slack season, it gets even slacker as you get into the monsoon, as construction, sugar, mining, a whole host of industries will stop functioning because of the rains. And in that period, banks will definitely have scope to cut rates, but just once. Because deposit costs also don't fall too much. Remember that the government has announced that for all small savings, Indira Vikas Patra, Kisan Vikas Patra, or a National Savings Certificate, NSC, all kinds of small savings are for this year going to get an interest rate of 8.75%. The biggest of them being, of course, PPF, which has a tax advantage as well. Now, if you're getting a rival interest-bearing bond at 8.75, obviously banks would be wary of going way below 8.5. At the most, they go up to 8.5. So if the cost of deposits doesn't fall so much because of competition from small scale, my sense is that lending rates also don't fall much. My own sense is REMI goes down once, not more than that.
All right, Lata. Well, let's quickly move on then and talk about all the repercussions of the RBI's policy in the market itself. Let's move to action on the Lal Street now, and it was mainly dictated by the RBI's policy today. Some sharp cuts came in after the governor decided not to touch rates, and while a dramatic pullback in late trade did manage to lift sentiment, it was just about enough to let the benchmark indices end marginally in green territory. Anuj Singhal is here with the day's trading action. Anuj, it's becoming a bit of a habit for the bulls to arrive late and then try and sustain this market.
Well, all's well that ends well. That's what the bulls would say after the kind of bizarre session that we had. I say bizarre because the market at points looked like breaking down, but the kind of run that we had in the second half had a lot of people surprised. The re-election was in the mid-cap space today. Traders would have made a lot of money if they would have got their individual stocks right. Banks continue to underperform, and that's clearly a story of the market, that banks have given up the leadership role. But today was, while policy-dominated headlines, really the re-election was in the mid-caps. I'll talk about that in a bit, but first let's talk about the stocks that actually led the market recovery in the late trade. Metal stocks did well. Stocks like Tata Steel, Sesa Sterlite, Hindalco, they were all higher. Apart from that, auto stocks, at least a couple of them did well. Mahindra & Mahindra and Bajaj, both were higher. Idea Cellular also has been a strong stock. On the losing side, as I said, banks clearly were the main culprits. So ICICI, SBI, Axis Bank, they were all lower. And a couple of other stocks that led the market down included Sun Pharma, which was essentially profit booking after a vertical rally. IDFC was down 2% and Tata Motors as well down about 1%. But take a look at the next screen. This really tells you the kind of gains mid-cap traders would have made. These are some of the stocks of the day today. United Breweries, SKS Micro, two stocks which are part of F&O, RCF up 20%. All these three stocks had massive volumes today. Not just that, I've just selected three. There were so many stocks. Take a look at some other stocks. Subex, HCC, Suzlon, lots of stocks up between 6 to 15%. A lot of F&O stocks up between 5 to 10%. So field day for the traders. And the sense you get is that maybe the next 3 or 4 days could belong to mid-caps.
All right, Anuj, thanks so much for that. Let's get to some market opinion now. Nilesh Shah of Kotak Mahindra Asset Management believes that markets will largely be driven by earnings going forward. In this regard, he expects earnings to pick up significantly only in the next financial year, that's FY17. So a big move in key indices may come only in the next year.
I think the market now can be driven by the earnings growth. We have seen last year PE ratio expanding from 12 times to 16.5 times. And earnings expanding by about 5 to 6%. Clearly, the scope for PE ratio expansion is limited. The earnings growth will be the biggest driver. Clearly, we see in some of the quality stocks where lack of supply has kind of kept valuations and prices at elevated level. I don't think so this trend can sustain for a long period of time, so it is very difficult to predict when it will end. The equity funds are more likely to deliver returns in line with the earnings growth, and we do expect FY17 earnings growth to be 20% plus, whereas FY16 earnings growth could be little muted. On the equity side, our recommendation will be to go towards more large cap stocks, more large cap funds, as the difference between mid cap and large cap valuation is very, very narrow. So over next 12 to 18 months, the large cap and a blend of large and mid cap funds should be able to outperform the market.
And now, for all the action from the futures and options space, let's go across to Nigel D'Souza. Nigel.
Well, post the big RBI event that played out today, the India VIX cooled down. That's because the IVs were falling in today's trade. But one got the sense with the recovery that we saw that maybe the Nifty has made some kind of a near-term base at around that 8,500 mark, because even when the Nifty had moved into the red, was trading with a cut-off around 15 to 20 points, we're not making any money on puts. So if you're buying those puts, you will not make any money. In fact, writing was seen at those levels. So the 8,500 put did see the premium move from around 55 rupees to around 50 bucks. The 8,300 put as well did see the premium crash a good 10% from around 26 rupees all the way to around 23 bucks. But on the upside as well seems to be capped, because the 8,700 call, that was fairly active in today's session. Remember, the premium is roughly around 100 rupees. So the smarter money will be selling that particular strike and hoping that the Nifty doesn't breach that 8,800 mark. The 8,800 call as well did see the premium over there fall from around 66 rupees to around 63 rupees. Remember, the Nifty ended in the green, but the premium on that particular strike as well didn't move higher, telling you that there is some writing being seen at around that 8,700, 8,800 call levels. Individual stocks that were in focus. Tata Steel did see big buying in today's trading session. Open interest build up as well was seen, with the stock flying away more than 4%. Century Textiles continues its good run. Today, in fact, the shorts were covering up their positions, and India Cements as well did see a bit of a short covering bounce in trade today. From the broader markets, we did see big buying on Exide in today's session, while REC on the back of that OFS hangover did see the stock ended lower by close to around 4%, and the open interest swelled up more than 45%.
All right, Nigel, thanks so much for that. Well, on that note, let's just get back to the policy for a bit. The Reserve Bank of India has given microfinance companies something to smile about. Stocks like SKS Microfinance and SE Investments clocked some firm gains. In fact, both were up nearly 10% in trade after the RBI extended the borrower level limit to 1 lakh rupees from 50,000 rupees earlier. Ekta Batra now joins in with more details. Ekta, tell us exactly what the RBI has now said and how is this going to help these companies?
Well, SKS Micro as well as SE Investments were a couple of stocks that were quite active. This was on the back of the RBI introducing following changes to the borrower level limits for microfinance companies. So, for example, the RBI extended the total borrower limit to 1 lakh versus 50,000 rupees earlier. The annual income limit for rural households was hiked to 1 lakh versus 60,000 rupees, and for urban households to 1.6 lakh versus 1.2 lakhs earlier. The maximum disbursement amount in the first cycle was hiked to 60,000 versus 35,000 rupees earlier, and the disbursement was enhanced to 1 lakh versus 50,000 rupees in subsequent cycles. Now, the feedback that we got is that overall it's a positive for the sector. It indicates stronger loan book growth going forward, and many of the MFIs had in fact witnessed saturation in some states. So, for example, the borrowers had already borrowed around 50,000 rupees. Hence, raising the cap to 1 lakh will enable the doubling of the addressable market size for a lot of these MFI companies.
All right, thanks a lot for that, Ekta. We have to take a break on that note, but coming up, Nirmal Jain of IIFL will join in to tell us what he expects from this earnings season, as also how stock markets will react to corporate earnings.